Topic of my video today is the most recent home price forecast from different experts. We'll also talk about mortgage rates and the silver lining to all this. Hey, welcome back to the channel. My name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Real quick, if you're thinking of buying or selling real estate here in the Bay Area, give us a call, a text, or an email. We would love to help you out. Let's get started. This is the most up-to-date information right now on home prices from what experts are saying all over the country. If you follow the channel, you know that I have been giving these type of home price forecasts every time they come out. In my previous updates, you can see that almost always the updates on price forecasts were getting revised upwards. That is not the case anymore. The narrative is starting to shift. Here's kind of the short version of what is going on. If you're waiting for home prices to crash, you might have to keep waiting. Demand is definitely going down, but supply is still an issue. And this is the reason why prices are just slowly drifting down. Days on the market is starting to get longer as more buyers are having a wait and see attitude. Basically, waiting for three things: for prices to come down, mortgage rates to come down, and more inventory to come on the market. And like I said, even though inventory is climbing, it's not to the extent that it's flooding the market. That is why there's really not a lot of pressure on price. So what do experts think? There is definitely a shift. Take a look at these latest home price forecasts for next year. The average of all five is now only 0.2%, or basically flat. The Mortgage Bankers Association with the highest at 2.8% appreciation. While on the other end of the spectrum, Ivy Zelman's forecast is a 4% decline next year. So two experts are calling for a decline and three showing appreciation. And when we average it, it seems like there will be no change, or flat if you will. This is on a national level. My disclaimer for this is that every market is different. For example, here in the Bay Area, in the South Bay, there's still a lot of pockets of strength in certain neighborhoods. In the East Bay, we are still seeing some multiple bidding going on in some areas. So be mindful and know what is going on in your local market. Okay, moving on. I want to give you another set of forecasts. This one is from Wall Street, Goldman Sachs, Wells Fargo, Moody's, and Morgan Stanley. All of them calling for home price to depreciate next year. So what's the difference? How come we have this variation? Well, most of Wall Street is actually focused on builders. You know, the likes of Lennar, Toll Brothers, and KB Homes, etc. And I'll tell you right now, with my own interaction with builders here in the East Bay, there are a lot of buyers that have canceled on contracts. And according to one builder that I talked to, they are down 70% in sales. 70%, that's huge. By the way, you need to know this. If you're buying new construction, it would be wise to take your agent with you. I had a client that I was able to get additional incentives from the builder after everything has been signed and they were under contract. When the market shifted and interest rates went up, my clients were wanting to back out and lose their $30,000 deposit. I was able to work with the builder to get additional incentives to make it work for them. I'm not saying or promising that it will always be like that, but you have to have your agent with you as an advocate. After all, salespeople on the site, they're working for the builder, not for you. Okay, back to our forecast. This is the difference between these set of forecasts. Banks and Wall Street focuses on new construction or publicly traded companies, while the others are looking at the resale side of real estate. They do, however, have one thing in common. Most of them are actually forecasting 2024 to be up again. Some marginally, some flat, but for the most part, the forecast for 2024 is calling for appreciation. We'll use Wells Fargo here as an example. 2023 depreciation, but in 2024 appreciation. Now, the thing with these forecasts, if you really look at it, they're just slight movements. Whether it's 2% up or 4% down, statistically, these are minor or small positive number and a small negative number. But for me, the impact of these numbers comes down to how we as consumers react to them. It is as if prices or home prices are never going to go up again. It really boggles my mind when consumers can easily buy a car and not worry about the fact that as soon as you drive it off the lot, it depreciates. And yet home buyers get so wrapped up in home prices falling when we all know that there's a lot of true demand and limited supply of homes. And what do most Americans want? To own their own home. So don't get bogged down by these small movements. If there is a need for you to buy a home and you are still able to do it, why not? Nobody's saying there's going to be a repeat of the mortgage crisis. It's not going to be like this. 5 years of straight depreciation like the last time. I mean, it's definitely not going to be 2020 and 2021 all over again. We are already experiencing the slowdown, and this is where most experts are somewhat in line. Slow down next year and then pick back up in 2024. And really, to some extent, some home buyers are starting to see that as early as now. They see home prices coming down, but not to levels where they are hoping it to be. And then when you factor in mortgage rates increasing, whatever price decrease or price savings that they get is actually just getting eaten by higher monthly payments. The wait and see game is actually not in your favor. This is a good segue into mortgage rates and the Feds. As long as the Feds continues to do their work to fight inflation, we will keep seeing higher and higher rates. As we continue to head into more recession, I say more because technically we are now already in one. So kind of looking at this from a glass half full perspective, when we go into a recession, guess what happens? Mortgage rates starts to go down because the Feds starts easing off, meaning they either stop increasing rates or start lowering rates to stimulate the economy. But make no mistake about it, before we start to see mortgage rates go lower, there will be a lot of pain before that. Just check out these headlines. These are the headlines that are out in the media right now. And this is the reality of rising mortgage rate environment. And when people see this, they get scared. That fear, that uncertainty, it causes you to press the pause button on your plans. So what we can see here, this is the Freddie Mac 30-year fixed rate from January of the beginning of this year all the way through today. And it says that mortgage rates rise for the 6th consecutive week. Those are the orange bars that you can see. You can see how rates have been rising since the beginning of the year. And look at the sharp incline that we've seen over just the past 6 weeks. Mortgage rates are rising very rapidly. I think this quote from Sam Cater of Freddie Mac sums it up. He says, "The uncertainty and volatility in the financial markets is heavily impacting mortgage rates. Our survey indicates that the range of weekly rate quotes for the 30-year fixed rate mortgage has more than doubled over the last year." The Fed's aim of curtailing demand by increasing rates directly impacts the housing market. What they are trying to do is bring inflation down. They're trying to slow the economy. So the moves the Fed is making to slow the economy is having an impact on mortgage rates. Technically, this is all about inflation. As inflation is high, mortgage rates tend to be high as well. And you know that inflation is the enemy of long-term interest rates. And that's exactly where we are today. And until inflation is down significantly, we see mortgage rates continue to rise. And the impact, like I have mentioned earlier, slowing demand, slowing prices or decelerating or even declining, and builders cut back severely on new construction. Annual house price growth has slowed down from a peak of 21% to 16%. That is the reality that buyers and sellers are facing right now. And this has been the trend even more rapidly over the past few weeks. We can expect rates to surpass the 7% level in the next 3 months. If you ask me, or better yet, watch my previous videos, even I did not believe we can cross the 6.5% mark last year or even the beginning of this year. I still wasn't believing we could go this high. We have to watch inflation to see where mortgage rates are going. I think this quote really is quite powerful. It's from Realtor.com. It says, "There's no doubt that the increasing mortgage rate will make home buying even more challenging. We're feeling that affordability pinch right now. That is loud and clear. But buyers may still find opportunities as these changes coincide with the time of the year when buyers historically found the best market conditions to obtain more bargaining power." Look, I'm not saying let's just look ahead and let's not worry about it. I don't think that's a wise way to go about it. But you have to look at home ownership as truly a long game, especially as we compare it to renting, and equity is the primary driver in that. Right now, according to First American, US households have about $29 trillion in equity. Homeowners have an average of $320,000 in inflation-adjusted equity in their homes in Q2 of 2020, an all-time high. Here's what I want you to take away from this. First of all, home equity is a huge source of wealth creation. You know, the net worth of a homeowner is 40 times greater than that of a renter. So when you start to compare home ownership to renting, it is a huge differentiator for people's long-term wealth gain. Also, recent record gains in equity are a financial buffer in case economic conditions worsen. We are not by any means going through another foreclosure crisis, but what we also know is that for anyone who might be in a challenging situation, they have equity in their homes, that can be a financial buffer when it's time for them to sell their home and avoid foreclosure. And in addition, the third thing, equity is a fuel for housing demand. It is what's keeping people in the housing market, keeping that demand high. We talked about it earlier. When the economic uncertainty does settles, equity is the driver that can help people fuel a move, relocate, whatever it is that they need to do, whether their needs have changed, their personal situation has changed, whatever it may be. Equity is huge in that. And what we can see in the latest release from CoreLogic is that the national average for home equity gain across the country is over 60,000, just over the past year. Now, this is Q2 of 2022 compared to Q2 of 2021. So we know now what that's a look back, and I hear you when you say a lot has happened since that data has been out. But think about it, 60,000 is a significant gain. Equity, again, is a huge driver. And if we look at the percentage change in home prices over time, this is where it becomes the long game. As we start to talk about what's happened over the past 30 years, this is the percent change in home prices as of Q2 of 2022, going all the way back to 1991. A 30-year look, the national average home prices have increased by 290%. That is massive. That is when we say home ownership is the long game. Home ownership wins over time in a 30-year period. Given all the ups and downs that have happened along the way, home prices are up 290%. In some places, like the Bay Area, significantly higher than that as well. So that is a significant source of wealth and growth for a homeowner. The question becomes, if this happened over the past 30 years, do you think it's going to be any different over the next 30 years? If you're asking yourself, should I buy a home now? I say, look at the numbers and make your decision based on that and not the headlines. History certainly doesn't always repeat itself, but we can learn quite a bit from it. In over a 30-year period of time, home values have increased significantly. And you know the alternative to this. I've said it before, renting. And look at how rent has skyrocketed over the same time period, roughly 30 years. Here you can see how much monthly rents have increased, and that is exponential. We know that there are certainly affordability challenges out there right now, but the real crisis right now is renting. As we look at how exponential this increase over time, I really want to communicate how much power there is in home ownership. And truly, it's not just a financial benefit of home ownership, because home ownership truly changes lives. There are so many non-financial benefits of home ownership that I didn't even talk about. Hey, that's our video for today. Home prices will probably be declining in 2023. Mortgage rates will continue to climb in the next 3 months. And should you buy a house right now? Let me know in the comment section below. Thanks for watching. Have a great day.